Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Plan. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes, and then today we are going to take a deep dive into breadth readings, and we're also going to take a deep dive into the U.S. dollar and how traders are currently positioned in the U.S. dollar and what that could mean for us moving forward. So let's jump right into the four major U.S. indexes. For starters, we'll take a look at the S&P 500, almost at new all-time highs, literally just a fraction of a percentage away from it yesterday. We're still technically trapped inside this range between that 40-50 zone and that 42-50 zone. We're looking for that breakout to the upside. Still looks very strong, this chart. The Nasdaq did go ahead and make a new all-time high here over the last couple of sessions, so breaking out from that potential ascending triangle pattern, very strong, looking very good. We take a look at the Dow Jones here. We know that that's been the strongest in the first portion of the year, and then it has been the weakest here over the last couple of weeks. It's the only index to undercut May's lows. So when we look at all of the other index charts, we're nowhere near where we were from the May lows perspective. The Dow went ahead and actually took that out. We did get a solid bounce, but we're now firmly kind of trapped in the middle of that range around that 34,000 level, and we're looking at the upper end of that being the 35,000 and kind of support being down there at 33,000. So this is the area of the market that saw some great movement in the beginning of the year. It's kind of cooled off, and we've seen rotation kind of back into tech. And so that's healthy when we put it in the context of everything else that's going on. The Russell's pushed up near those all-time highs there. A little bit further off than the other indexes. We're about 2.5% off of those highs. It has just been trapped inside this range all year. We know that we had a phenomenal end of the year out of the Russell last year, and then it has really essentially gone nowhere from that time. We're really paying very close attention to see how this resolves. A move to the upside would be very, very bullish across the board. Staying trapped inside this range, there's absolutely nothing wrong with that. We know after we have a huge explosive move, there's kind of two ways the market can digest that information. It can go ahead and pull back, or it can trade sideways over time and kind of digest that before making its next leg up. So good price action across those four major U.S. indexes. Now, let's jump in and start talking about breadth here. Now, when we look at the Nasdaq McClellan Summation Index, we've talked about it a lot, and we can draw kind of that technical line right there at about that 300 zone. This, over the last year, has been a very important technical area on this chart. You can see a move above it has been really strong. It kind of acted as an area of support. When it broke, it became resistance, and here it is acting as resistance once again, and we have our crossover to the downside. That means that we're not seeing the breadth that we want. I've got some more data sets here that'll really take an in-depth look at that as well. When we look at the S&P 500 right here, we see a very odd thing occurring. We have almost all of the stocks, and over 90% of those stocks, above their 200-day moving average, but 35% of them or less are above their 50-day moving average, meaning the long-term charts, the stocks are still above those levels, but in the midterm, we're seeing that breadth deterioration, and that's very clear by the difference between the 200 and 50-day moving average and what percentage of stocks are where. Another way of looking at the breadth reading is the S&P 500 was within 0.25% of a 52-week high, and in this particular example, of an all-time high, but less than half of its members are above their 50-day moving average. This is one of those signals that rarely occurs, and it has preceded a negative return in the stock market every single time that it has happened in the last 100 years. You can see these signals showed up a lot in 1929. They also showed up there in the 1970s and also 99, so the dot-com bubble. So again, there's not a ton of data sets, but this is one of those things where every single instance of this happening in the past has preceded some really nasty market environments. So it is something that's certainly worth paying attention to. Now, that being said, after this occurred, we then saw an incredible bounce across the board on Monday where almost everything was up. On Monday, we had more than 450 of the S&P 500 components up versus the 50 or so that were down. That is a number that does not occur very often. What we can see when we look at the average returns and the median returns when this does happen, we run into some short-term weakness over the next month or two. Again, I'm thinking as the market kind of digests that incredible move, but what we can see is 6 months later, a year later, it's very positive for the market, because when you get really, really strong breadth readings, usually you get some follow-through over the long run. So now we've got two different data sets that are telling us different things. One, we've got the S&P 500 almost up at those all-time highs, but less than 50% of them are above their 50-day moving average, which has preceded some very negative time frames. And then we have such an incredible breadth thrust on Monday, which gives us a data set where a year later we're positive 100% of the time. So what's kind of the takeaway from this? We have to continue to pay very close attention to the breadth readings. We know that we're right at a very, very key level when we look at that Nasdaq McClellan Summation Index around that 300. If we can push up and that breadth reading that we saw in that thrust from Monday continues, that would kind of negate all of the worry that I've got from the data set that took a look at what happened in 1929, the 70s, and the dot-com bubble. If we fail to continue to see that breadth increase here and over the next month or so, that's going to be a bigger concern here for the long-term health of the overall market. Now, we keep talking about the US dollar. We've mentioned it many times, how we are at a very, very important key level that's playing out here over the last couple of decades. And I want to take a deep dive into how traders are positioned in the US dollar at the moment and what this has preceded historically. The majority of traders are actually bearish and negative on the US dollar at this point in time. And this is one of those indicators where a very high percentage is, meaning more than 50% are actually on the short side. And this has been one of those market environments where below 50%, the annualized return of the US dollar is over 2% to the upside. And it's a rare occurrence. It only happens about 15% of the time. The majority of the time, the market is in between that negative 50 and 50 zone. Right, and above 50, that's where you get everybody really bullish on the U.S. dollar, and that has that negative annualized return, and that happens, similar, less than 20% of the time to the opposite. So it's worth paying very close attention, and what this is saying is the majority of people are bearish on the U.S. dollar, and when sentiment gets to those extremes, that's where we can have some large moves in the opposite direction. And historically, when we see the positioning this way in the U.S. dollar, we tend to see a rally happen out of the U.S. dollar. And when we look at our chart, where are we at? The bears have not been able to break that 90 zone. It's holding this area of support. Fed talking about rate hikes. This could be an environment where we could get that squeeze higher out of the U.S. dollar. If we continue to see that bullish move higher out of the U.S. dollar, this is a chart of what we typically tend to see return-wise out of some of the other major markets. The S&P 500, it's about split a little bit more bearish, of 43% of the time being positive. The Nasdaq doesn't seem to mind as much, as positive 70% of the time. But then we've got gold and commodities are just really beat up, and the worst performer in a major rising dollar environment is going to be those emerging markets where they're positive a very low percentage of the time at zero, right? And that makes sense because emerging markets, again, everything priced in the U.S. dollar, a strong U.S. dollar is bad for their economy. A weak U.S. dollar is good for their economy based on the way goods are priced. Same thing with commodities. So we are at that really important turning point. I know I've been harping on this because it's that major key level out of the U.S. dollar for quite some time. We still technically have our downtrend in place, right? We still have lower highs. We had a really nice strong bounce there off of the Fed, but we didn't take this out. So we still have those lower highs in place, but the problem is we no longer have lower lows. We kind of have that flat top bottom. So we've got kind of a setup like this in a downtrend, but on major, 15, 20-year support. What happens here out of the U.S. dollar, I think, will have huge impacts here on the markets, on commodities moving forward. We still do not have a resolution, and we're going to continue to keep talking about this in these videos until we do get that resolution, because it is really important, and I think it will have a major impact for us moving forward. So we're still kind of in that let's wait and see what happens phase, because we don't have a trigger either to the upside or the downside for us to be able to make any really good call. And that's the great thing about what we do. We don't have to take a position. We can wait until we get that confirmation before making those decisions. And that's what we're really taking a look at here. As always, I hope you guys found this information useful. I hope you have yourself a fantastic week. If you want to reach out to me, you can at mtedeschi at perspectivewealthplanning.com, or you can give me a call at 814-580-9881. I'd be more than happy to talk anything about the markets with you guys. Have yourself a fantastic week. I'll see you next week. Take care.